Welcome back. You're watching Money, 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 and this week we are in conversation with the gentleman from Axis Mutual Fund to figure out how you can get a little smarter, maybe a little more organized and systematic with your mutual fund investments given the huge surge in the equity market. So Chandresh, I'm going to come back to the question on debt, because debt funds are a new phenomenon, a new concept for the retail audiences. Yet they've figured out that there is a merit and there is a tax advantage as well over and above a fixed deposit to be in debt funds. But given how the market is moving, and now again we are seeing bond yields move on the higher side, little tough to understand the right product to get into. So do help us out here.
Yeah, I think from a retail investor's perspective, when I'm assuming the risk appetite or the ability to withstand too much volatility is not there, to stay in the lower duration bucket is where investors should really focus on. And there are a couple of alternatives there. One is to be at the real low end, which is the ultra short-term kind of a space where yields are not that high, but it provides you a lot of flexibility in terms of liquidity. And if you really don't have money for the long term, which is 3 years, because that's where, as you said, the tax advantage really kicks in. That's the space you may want to stay with very low volatility. And if you can spare money for the 3 years, which is when the mutual fund product really becomes
quite superior,
compared to an alternative asset classes, alternative opportunities, so to say. And there also you can either choose for a very highly rated short-term bond fund, or you can also start to look at slightly higher yields. I mean, that depends on the risk appetite. So I think overall there are three opportunities. One, for less than 3 year money, typically stay, and with low volatility, stay in the ultra short-term bond fund space. And for people who would like to actually use this as income generation can have investment for longer periods of time, really take the advantage of the tax regime, 3 years and plus, lower risk, the short-term space, and then the accrual products, which is a little bit of higher yield funds where we invest in slightly lower rated credit papers. One of the things which we are really excited about.
So anything that you would recommend again from your own portfolio when it comes to
so I think from an Axis perspective, on the accrual side we have the Axis short-term fund, and on the accrual higher yielding side we have the Axis fixed income opportunities fund, as well as the regular savings, Axis regular savings funds. I think these are all products for the investor who's looking to invest in debt long term. This is going to be long-term asset allocation.
I'm asking 3 years plus, because that's when the differential is quite significant.
These are both really ideal products for that investor.
What do you like the most in the market right now? I mean, I don't know. Are there any high conviction areas where you think a sector is about to take off, so maybe that sectoral fund can do really well?
So as a house, we are not that gung-ho on the sectoral.
It's too much of risk concentration.
Too much of risk. Yeah. Memories are short. If you see what happened in the, just to give you an example, on the infra funds when the 2008-9 the bubble burst.
My memory is not short. I remember very, very clearly because I had some money in such funds. But yes.
Since you asked me this question, so then what happens? Suddenly the flavor goes away. So if I can give you some kind of participation in the diversified schemes, why bother so much into going into a specific sectoral scheme?
Absolutely. Okay. Well, that brings me to some closing thoughts then, Chandresh. And yes, the regulator obviously wanting to make things more streamlined, I think, for the investor, with the circular that came out that said that you have to have certain clear definitions of what is large cap, what is mid cap, what is small cap. The nomenclature changes, as we refer to on the debt side. What is the response so far? At your end, do you think there will be a lot of churn? Would you have to sort of reorganize any schemes, or is it largely neutral?
Yeah, I think there will be some reorganization. I think, however, at Axis, we don't have too many products. So we don't have a plethora of products. So we don't see any scenario where we will have to merge schemes or consolidate schemes. That's not going to happen. But in line with the definitions which are there will be some definition changes of the product. We don't see any major changes in the portfolios.
Okay.
I think there may be one or two products, one on the equities and one on the fixed income, where there will be a marginal 5 to 7% correction in the overall holdings of the portfolio to get in line with the new circular. But otherwise, it's for us, it's a very welcome step. I think the whole idea about getting investors to understand the products which they are investing in, and not bombard him with a number of different ideas and concepts which retail investors find it very hard to, one, understand, and then to obviously take it with them from a longer term perspective. You kind of just give it up. You learn about it and you give it up, and so it's a re-education of sorts which we have to do all the time. I don't think that's really helping the industry anyway. So this is a really welcome step from an investor's perspective. From our perspective as well, I think products are anyway clearly positioned. It will get more clearly positioned in the minds of the investors. So all in all, it's a very happy exercise for us.
Okay. Thank you very much, Jinesh and Chandresh, for being with us on the show.
Thanks for having us.
Great conversation. Well, we will take your leave as well. Of course, your feedback, queries and comments are welcome as always. We'll see you again with another set of guests and another theme next week.